Very well. Thanks for doing this, Tim. I'm Maj from GeoInvesting, co-founder of Geo, a stock research platform for nanocap and microcap companies, or actually for investors. We do them on we write research on these companies, and we're here today with Tim Heitman. He's one of our longer GeoInvesting subscribers, and this has been a long time coming, Tim. I've talked to you for some time now, and
Couple of years.
a couple of years. Yep. And I really value your way of looking at companies and the way you break them down. You're very analytical. Financial modeling is pretty awesome. So I'm looking forward to having this call with you today.
Well, I dressed
And
up just for the occasion here with my Trading Places reference.
yeah, great movie. We need a little of their help these days. They're
Oh, yeah, where's that inside information on the orange juice?
yeah. I don't even think instant information will help anyone in this market and now cap land.
Oh, no
It's
kidding.
crazy. But yeah, so let's learn more about you. So Tim, tell us about yourself. Your beginnings, how you became an investor, your private life, and what you do. And so we can all get a sense of how you kind of got into investing.
Sure. I'm probably one of the older guys you'll ever talk to that's still in the business. I actually started in 1983, so this is my 40th year in the business. My dad worked for John Deere. He was on the marketing side, like national sales and things. So as a kid, I was always around kind of professional business people. And I was one of those guys that would look in the paper and see that a stock would be the 52-week low was 50 and the 52-week high was 100. And you're like, wow, if I could just figure out when it's at 50 to buy it and when it's at 100 to sell it, that seems like a pretty good deal. So
Right.
I was always interested in business from my dad, and then I was always fascinated with numbers. Went to Miami of Ohio, got a finance degree. So I kind of always thought I'd be in the business. And when I moved to Dallas, I live north of Dallas, I got a job with Fidelity Investments. They were moving out of Boston. I was actually on the retail side. I had a Series 7 and all that stuff. But that was back when Peter Lynch was there and, the go-go days of the 80s.
Wow.
Uh, so I got to meet Peter a couple times, and just Fidelity was a research shop back then. That was their thing. And I always wanted to go work as an analyst. I thought, wow, maybe I'll be able to get over to the Boston side, being here in Dallas. That wasn't going to work out for a lot of different reasons. Have an MBA and never really wanted to go to Wharton or someplace. No offense to Wharton, but that's just
Right.
lifestyle. So I left there. Worked for a private broker dealer for 10 years. I was the trader. I was the analyst. I was the guy that filed the forms. That was a very educational thing. It was like a 3-man shop. I got to trade back when Madoff was, a real firm and not a fraud and doing. They got acquired. I went to work for a guy named David Tice, who some people may know. He ran the Prudent Bear Fund, which was the largest short-selling fund in America at the time. So this 2000 to 2008 when I was there. And that's really where I learned analytical skills, because there wasn't really a short-selling research product, but Fidelity and people like that would hire us to look at companies to make sure that, if it was a 20% growing company and they were paying 30 times earnings for it, it was really a 20% growing company, and they didn't want to pay 30 times for a 10% growing company. So it really helped me kind of understand Wall Street business models, how businesses actually worked, and kind of connected cash flow statements with, business models. And that's been the genesis ever since, as far as kind of why I do what I do and the way I model. After that, that company was sold. So I went to work for a friend of mine who I knew back when I was a trader back in the 80s, who ran a hedge fund called Manalapan Oracle. He's actually, Glenn Viddick is his name, and he actually is in one of the Market Wizards books. So there I was director of research and a partner, and it was a long, short fund. And so we were there from 2008 to about 2012 or 13. So we survived the crash and the nonsense and all that. And
Mhm.
after a while, you just kind of get burned out. That was a stressful time and lots going on. I do have a second career that I've had for 30 years as a sports photographer, which kind of takes me away from the day-to-day. It's my night job that was a hobby that's now a night job. So that gives me the right brain, left brain perspective. So I've done everything in the business except a compliance officer pretty much. And
Right.
there's no upside to being a compliance officer. So that's kind of how I got to where I'm at. When COVID happened, all my photography stuff went away, and then that's kind of how we ran into each other. A Zoom call on one of the companies. I can't remember who it was, and I've followed you from before and liked your style. So that's kind of how we got to the present.
Awesome. And so would you call yourself, I mean, I know you have your side gig is your photography. Would you call yourself a full-time investor? I mean, is that how you would kind of label it here?
Yeah, I would say I'm full time, because it's not my sole source of income, but when I'm shooting projects, they're at night. So during the day, I still get up in the morning and read financials and do that. So it's
Right.
it's a business where you never really retire, right? I mean, just always do it. So I would say I'm a full time investor with a
Awesome.
second gig.
Any good Peter Lynch stories from
And
back in the day?
no, he is exactly what he appears to be. He's one of those guys that was nice and funny and laid back, and he had that premature gray hair. And he would get on calls, like there would be sales calls, and every now and then he'd kind of join because obviously everybody wanted to know what Peter Lynch thought and everything. And all the quirkiness was true. The whole thing about you get three, he had you have 3 minutes, and he put down the timer, and you have 3 minutes to do the deal. And he was just always thinking, and he would buy every stock in an industry. Like at one point he owned every public savings and loan in the country.
Wow.
And it was just unique how he could own 1,000 stocks in a bear market and still throw up 20% returns.
Right.
He was just like 24/7. That's all he did. He just thought about them. The whole thing about, in his book, which I would recommend, Went Up on Wall Street, the walk in the mall and all that back then, probably doesn't work as well today as it did back then.
Right.
He was exactly as people think that he was in person, which was great. Not everybody is.
So you have about this 3 minute kind of time limit. Was that during like a pitch session for a stock, for example? That's how he.
Yep. Yeah, because one, he had so many stocks to pay attention to, but two, his premise was, if you can't tell me in 3 minutes, what the investment thesis is in a clear and concise way, clearly there isn't one, right?
Right.
And I think a lot of people like to be dazzled by 20 or 30 page in-depth, oh wow, this guy knows everything. Sometimes it's just as simple as they're number one in the industry, and here's how their margins are higher than everybody's, and it looks like that's going to continue for a while. I mean, I think sometimes people get too involved in complicated thinking, and that they think their edge is they know a company better than anybody else, and I don't think that's true.
Right.
Necessary.
It's funny because before our call today, I had a one-on-one Zoom meeting with one of our newest members at GeoInvesting. I do that a lot if they want to have a one-on-one with me to learn about the platform, what we do. And this subject came up about these reports, how long should they be, and how do you go about through, research process. And we talked about my new product, my Cliff Note product, which I don't know you and I have talked about yet, Tim, but it's a very quick, kind of concise way of looking at a stock, getting it down on paper right away, and putting it on in your pipeline. And I know that, I was, Peter Lynch's book, Went Up on Wall Street, and I've talked about it a lot, was my first book I read. And the only book I read for many years. I just loved it so much. I didn't want to get, sidetracked. And I remember from my very early days, that's what I used to do. I used to do it, obviously, in a 3-ring binder on some paper, and I would just write down, a symbol, a few sentences, why I liked it, and then my tasks I had to do to know about it better. And I guess that comes from reading that Peter Lynch book, right? And now you mention it, I didn't realize it at that time, but of course that's what was going on there. And I actually think that helps you think about companies in a much different way. It forces you to really drill down, what are the most important parts of a company. And there's, I think, from a situation where you can find many reasons not to want to buy a company too. And I think that if you sometimes the further you dig, sometimes you find you talk yourself out of buying it because you find too many risks. I'm not saying that you shouldn't be aware of these risks, but I think that there's a way to really concisely opportunity, risks, caveats, valuation. You can kind of get a good sense pretty quickly once you're good at this game of getting that at least initial pipeline that you'll want to look at pretty quickly.
You know, two of his other famous sayings that turned out to be true was if I think I'm going to paraphrase both of them, but one of them is, if you spend 13 minutes on the macro, you've wasted 8 minutes of time.
Right.
And now, and it seems like people focus way more now on the macro than ever before, and maybe that's necessary. But I think we'll talk down the road about why I think one of the ways I do my work kind of, I don't want to say neutralizes the risk of macro, but we'll talk about how I think about macro in individual companies.
Perfect.
But the other one that he said was, know what you own and know why you own it.
Right.
And to your point, you can describe why you own it, what you own and why you own it in a couple of sentences, or just a very basic outline. Because you're right, there's, you go through a risk section, there's probably, let's take out the generic risk section, right? There may be 5 to 20 company specific risks, right? Our financing, or if our president leaves, or whatever, right? There's going to be a whole list. But I'm sure you do the same thing. After a while, you can go through the 20 and you're like, okay, well, these are really the only 3 risks.
Exactly. Yeah.
Right. I need to focus on getting comfortable with those 3 risks. The other ones, every other company will have in some form or fashion. Right.
Right.
So
I know.
I think that we think similarly that way.
Yeah. Now you take it, like the income statement, boom, margins. Okay. Look, that's real good margins, real low margins. Okay. Right, note that down.
Yep.
If I see, a 25% pre-tax margins, that's pretty fucking good. I'm writing that down, right? As a thing.
Yep.
All right, well, you know what? It has 25% pre-tax margins, but it has all this debt, all these little things, which, you start balancing it all. And I'm looking at these quick things, all the important spots: income statement, balance sheet, cash flow, risk factors, liquidity section in the SEC document, making that quick assessment, management discussion, analysis in the SEC documents, hitting those important parts really quick, looking at a conference call transcript really quick, and the press release, and then wishing all together. And I think you can do it. And it can be done quickly. So
that reminds me, when I was at David Tice, so I wasn't working for the mutual fund. I was working for a product called Behind the Numbers, which was back in the day a $15,000 a year plus subscription service for institutionals only. And it would be Fidelity and Federated and T. Rowe Price, but then it would also be George Soros and the short seller guys, because they wanted to be on either side of the same trade. And one of the techniques I learned there that David Tice taught me was this thing that he called the 1 hour analysis, which goes right to your point. And it's a book. I probably still have it in my closet that has, kind of, here's our process of how we do everything. And it usually takes about 3 days to do a 1 hour analysis, but a 3-day analysis doesn't have quite the clever ring to it, right? Right. But in essence, that's exactly what the 1 hour analysis is. It's consistently looking at the exact same things. You get into a pattern recognition and you get the basic things, because we had about 5 analysts that were looking at, a couple thousand stocks a year. So you couldn't spend, and when we published every couple of weeks, so you couldn't spend 5 months on an idea, right? You had to move on. And so you could pick an industry and go through 10 stocks in an industry in 2 weeks. And then you could decide, okay, there's something there or not, but now you have your outline, and then you can go back in 6 months and you've already saved the time. So this 1 hour analysis strategy is, again, something that you do in a different way, but I think it's extremely helpful for someone, because I like to say I'm an analog guy. I'm not a digital guy, in the sense that I don't do screen, like my screen will be, show me every company in the industry and rank it by like enterprise value.
Right.
That's not, because a lot of the things we look for are changes from the past.
Right.
Catalyst is an overused word, but it's also the word to use. And management change is a big catalyst at our level, at the microcap, nano cap, small cap level. But if you're just screening for price to book or enterprise to sales or rate of change of margins, everybody sees that, right?
Right.
So, and it's not to say that some of those things aren't useful, but if I'm using a computer to screen for ideas in an age when everybody has a computer, not so sure that that's, an edge.
Well, the cool thing about that too is, I do know some pretty good quant investors out there. And the thing is, though, you can find these stocks before the quant finds it, though, right? Because if you are predicting change, and you might be able to get 20, 30, 40% 50% alpha before all the stuff is even evident in the numbers.
Yes.
So that's why I like about having that kind of qualitative kind of edge too.
Yep.
I think you do a lot of that, and I think you combine them beautifully. It can be really good.
Exactly.
And I mean, I'm really curious how if, as AI evolves, if it's going to be able to help with finding the qualitative, buried in the transcripts and SEC documents to somehow put everything together a little bit. I don't know yet, but it's going to be interesting.
And I mean, I think it has some potential to do that, because now, I do these primitive word searches, whether it's on Seeking Alpha or you take a 10K and, you do a keyword search, but that's pretty inefficient if you could train AI to look for similar concepts. Like, one thing I noticed that seems where AI is starting to be a problem is, I'm sure you notice it all the time, after hour stock movements based on earnings reports.
Right.
It'll be down 10%, and then it'll be up 7%, and then and it's always like, the initial reactions are the quants reading the thing, oh, earnings declined or decreased or margin, whatever, up or down, right? And then so they kind of act on that. And then you have the people that actually are on a conference call and they're like, oh, well, what they said was not as bad or worse or what.
Right. Non-GAAP number, gap number, right? And all these headlines.
Oh, yeah. So I think there's already some of that creeping in, but I don't think it's an efficient use of AI, especially if you can do transcripts and do, like 10 transcripts, go historical, and you can find, change in tone, or they start emphasizing different, or they change their story, or, oh, now we're this kind of, you might be able to pick up things on that. And if you can do a whole industry, like I do the restaurants, and there's probably 34 public restaurants. If I can do all 34 restaurants using AI to screen for certain things, that would be days and days.
Well, I think it can definitely help us bring stocks into the bucket faster, for sure.
Yep.
And I'm working on some things there, but which we can talk about later as we move on through here. But cool, man. So this is going well. This is awesome. So I'm looking at some notes here. So let's talk about maybe, have you always invested in nano caps, or were you investing in large caps for a while too? Where did you start that process actually?
I never really got into nano caps or micro caps per se until like the last 7 or 8 years. And part of it was because I was always an analyst at a firm. I was always an analyst. So I was restricted by, the amount of money that whoever I was working with did. So I wasn't in charge of the investment philosophy or the process, right? So everywhere I worked, they generally looked at large cap or mid cap. And going back to Peter Lynch or any of the, Buffett or any of these guys. And remember, I'm so old that I probably have first editions of all their books, like as opposed to the third or fourth edition. And I've got an Adam Smith book back here and a Louis Rukeyser book back here, which many of these people watching this may not even know who those people are, right? So back then, plus I was a big value line guy. I still am.
Love value line. Yeah.
I mean, talk about a quick way to look at something. That's the perfect screener, right? If that's the only screen if you said you could only use one thing to screen with, it would be value line.
Right.
But over time, as markets became, I hate to use the word efficient, but as markets became more efficient and there was less information arbitrage, think about it. At Fidelity in 1983, every public company went through Fidelity's offices, right? So if you weren't, so they could gain, and this is before Reg FD, and not that they used insider information, but they had a huge analytical advantage, right? Plus, annual reports came in the mail, and you had to, write to the SEC to get stuff, right?
Right.
So now that information dissemination has been globalized and democratized, and everybody can have it, that edge is kind of gone, right? Except in the microcap, nanocap space. It's still the most inefficient, in my opinion, still the most inefficient place where someone that has an analytical skill set of some kind that they can apply, it doesn't always have to be, it could be quant, it could be technical analysis. I mean, that's another thing I'd like to point. You can be successful as an investor in like anything, short selling, long, but if your personality doesn't match the skill set that's needed for that, it's going to be a train wreck, right?
Right.
So I don't want to say that value investing is the only way to go, although historically there are reasons why it probably is more sustainable. But I kind of got involved in the nano cap, micro cap space. Like I said, when I finally retired and was just doing my own work, because I actually had the opportunity to do my own work for myself, where before I was always for somebody else. I mean, I may piggyback on the edge, but I just left my money with them or whatever. So,
Hmm.
so it's probably the last, let's see, this 2013, maybe the last 8 years. And then when COVID hit, I really got involved, like a lot of people, and benefited for a year and then blew up for a couple of years. But I still think, and when I came across you and like Chris Lahiji at LD Micro, and there's this core, I call them the microcap mafia when I talk to companies,
Hmm.
that really understand how that works. And it's just this great group of idea generators that have skill sets that apply to a place where alpha can be generated. So it's just, and it's a way more interesting space. I mean, who cares about Apple or Google or, I mean, what value are you going to bring to that, right?
Right.
So,
Right.
so I do think it's literally the last frontier. The problem with microcap investing I found is it's really hard to get the incremental buyer to make your idea work, right?
Right. A lot harder than it's ever been. It used to be a little easier. I mean, back in the day, it was a lot easier.
Yeah, because and now like the sweet spot has moved up, right? Like in terms of the market cap. When I started, a $2 billion company was a large cap, right?
Right.
Now it's not even a small cap. Uh,
Uh-huh.
and now, like the guys that I respect, like one of the places for idea generation I use is I just look at the annual reports of investors that I like Parrott is a good small, micro cap guy. Heartland, Royce owns too many stocks, but they have some interesting ideas. So
Right.
I like to look at some of those, and you can see how they've moved up their market cap to 500 million or 600 million. I mean, hell, there's a micro cap fund out there that has like a $10 billion company in it.
Oh, wow.
So as those guys have moved kind of up the spectrum, it's hard. They used to be the incremental buyer.
Yeah.
And I think we might talk about Mama Creations in the future. What's interesting is Parrot. No, there's another company called 180 Degree Capital, which does microcap investing
Mhm.
and fund. And when Mama Mancini's placed that giant secondary offering with Carl getting out of the way,
Right.
those guys showed up and their cost base is $2.50 they bought on the bid. So
Right.
if you own a $20 million market cap company or $70 million market cap, that's really got to work from a financial standpoint for the year to get people interested enough. Whereas, if you're in the 100 to $400 million range, there's still a lot of those institutional level guys that can, or office guys that can help you out.
Right. The way I look at it, it was one thing is, oh, by the way, on the efficiency of the market, I think ironically that even though you could argue that the market's more efficient because there's more information, it might be more inefficient than ever in microcap land because there's so much information out there, first of all,
Mhm.
right? You don't know where to get it, but because there's so many less eyes on the nano cap industry than ever before, or market, that it's inefficient in terms of it's efficient in terms of information being available. I think it's inefficient in terms of just not enough people looking at it. So you can get this great edge in finding free public information that's just being ignored.
I agree. I agree.
Especially the smaller you go down. I mean, I don't know if you saw that one stock we just recently put on Geo, the Mojo, MOJO,
I
which
saw it because of an interesting ticker.
right,
I haven't looked at it yet, but go ahead.
which I do own and have to disclose it. And the stock went from, I think, 25 cents to now it's 60 cents in a relatively short period of time. And it's in a run to one model portfolio. These are stocks that are under one, we think can go over one.
Yep.
And I'm sitting there using this press release tool that I built, which you'll see soon, Tim.
Yeah, there we go. We're on the first step.
Yeah. And I came across this Mojo, like, oh, great. Here's one of those wonderful nano cap symbols, Mojo.
Exactly.
And so that's a beverage company, and they have this coconut water drink, and we'll get into it later, maybe. And now they're launching an energy drink line to focus on women. But there was a press release out there that I came across that didn't really screen well at all. I mean, and you read into it, and It was just a release about the company buying back stock. And we're buying back stock. And not only are we buying back stock, this is how much stock we bought in the last year. And we're reducing the amount of authorized shares
Oh,
from
wow.
like a huge number to like 20 million. They only got 17 million outstanding or something like that. So he's basically telling you, and it's, I went, okay, let me see this. Let me put the ticker in. And I went back because on this tool I built, you can see all the releases and what the prices were at that time.
Oh,
And they've
wow.
been putting these releases out for some time. And this, since like 10 cents. So, we found at the right time, and this thing was not trading at all. It was only them buying it. So that's an example of information just sitting there for several weeks, maybe months, with the company telegraphing this stuff and they're not moving at all. No one caring, and they're profitable, by the way.
Yeah, that reminds me of two things. There's another company, it's called Four Corners, which does bingo cards and stuff in Texas. And it's highly illiquid. I am long. I'm not recommending it because it's just, you can't buy it. But the other thing about value investing that I think a lot of people, why they don't like it, is the example you gave. So here's a stock that's 20 cents for a year, 2 years. Let's just say it sits there for 2 years, but things are happening and you're aware that things are happening. Then there's the old saying, it doesn't matter until it matters, right? Now it matters, and it matters to other people. So now you've gone from 20 cents to 60 cents. So you've tripled your investment in 2 months, but it's still a pretty good return over 3 years, right?
Right.
A lot of the value stocks that work are this kind of hockey stick because it doesn't matter until all of a sudden it starts to matter.
Exactly.
So and the other thing is, if you own a stock that doesn't go anywhere for a long period of time, but they keep active with releases and things, the longer you are with a company, the more you understand it, right? The more you understand the nuances and the changes. And so you can recognize that things are getting even better. At some point, something will happen. And I bring up this Four Corners. Like I said, they're I don't know if they're even maybe a $20 million market cap company.
Is that a FCN? What's your symbol?
Yeah, FCNE, right?
Okay.
Up probably on Value Investor Club or something a long time ago. And they basically just sell bingo cards and the card readers and things like that to charities and churches and things in Texas. And they're number one in the industry, and it's not going to grow, right? I mean, it's just sitting there. But the stock at one point, the stock was $1, and they brought in a new CEO. Talk about our agents of change. Sometimes new CEOs are good, sometimes they're worse. But this guy came from another public company that used to do the bingo up in Oklahoma. Still public company, I can't think of the name. But I mean, he knows what he's doing. And the company was a family-run company before he got there. And it wasn't doing anything. And he brought in professional management, another theme that I like, right? Some guy that I always like to ask these guys, you were with a bigger company. Why the heck did you come to this little teeny tiny company? Didn't take a bunch of free options. You're going to make your money because the company's going to grow and you'll make your money. You're not going to flip it, right?
Right.
And so he explained to me how they used to run it as a family. They didn't run it as a profitable business. They just ran it as a family business.
Right.
And he turned it around, and it's probably 40% owned by 4 or 5 people, 2 generations. And he's like, and what I discovered was, he's like, look, these guys can't get out of this company. They can't sell the shares. There's no market for it. So the only way they're going to extract value is if I pay out the free cash flow as a dividend.
Right.
And the stock was trading at like $1.10. And he's turned the company around. Again, it grows a little, but not really. But they pay a 20-cent dividend.
Oh, wow.
20-cent dividend now. And I mean, it went from like 2 cents a quarter to 3 cents a quarter to 4. So it's like 4 or 5 cents a quarter now. So now the stock is $2.10, yielding 10%. But there was an opportunity when you understood how the business worked. So the stock has doubled and you're still getting, a 10% yield.
I see it here. Yeah. Look at that's nice.
I mean, if it trades 100 shares a day, good luck. And it's probably
you gotta get
spread in it, but
you gotta get enough shares to make it worth it, I guess, to get that nice dividend, right?
yeah. But
I mean,
that's
you think they'll sell the company? Is that part of the strategy too, or no?
yeah. Because the original founder and his family and the owners, are probably in their like the second generation doesn't care about it, right? So at some point they'll probably sell the company, and the number 2 guy. So all the other companies are private in this space, but the number 2 guy, if these guys own 4 40% of the market, these other guys own 20.
Okay.
If they could own 60, why not? And it's not going to be a FCC. Oh my God, you guys are monopolizing the business. So there could be an exit strategy, but until now, it's just kind of a nice annuity.
All right, well, that's worth it, right? So,
Absolutely.
and at some point, people might want to, bid it. What's the yield in the stock right now? Let me see here.
It's like 9.
Yeah. So maybe why? Maybe it gets down. Maybe it gets up to a 5% at some point, right? I mean,
Right, it reminds me a little bit of that Mills Trust. Remember MMTRS, the royalty, like the first royalty.
oh right, yeah, yeah.
Company. Now there's Warner Music and a few others, but
Mhm.
the same thing happened with that. It hardly ever traded. It had like a $5 spread, and it was yielding like 15%. And somebody pointed it out, and eventually, the payout's pretty stable because it's all these old songs that people use forever. They still have rights on, and yeah, they just, at some point people revalued it. And they said,
Right.
hey, maybe it should be a 6% yielder instead of a 12 because of whatever. So
Is there anything in their business plan that could lead to growth, that could lead to a acceleration of growth, or is it?
no, because look, the business is just like one thing that's interesting is I thought this was basically just old ladies playing bingo, right? In a big hall. But a lot of their business is actually schools and other people that use and charities that do it for fundraising. And there's some nuances in the rules of Texas about what games you can offer and how, and it's more than just because the big deal are these cards that you can buy where instead of winning $25, you can win like $5,000. So it's like
Oh wow.
it's like a mini lottery kind of thing. But you play using bingo cards. So, I mean, if they got a little more aggressive with kind of reaching out, and I mean, it's grown like 5 or 6% a year for the last 5 or 6 years. Its business is higher now than it was before COVID, which is,
Is it only a Texas play? I mean, is that the only place they?
It's the only place they are. I asked them about that. They were in Oklahoma for a while as well, but like Texas is the biggest market that has the best. I mean, they're number one, so they have the least amount of competition. They've been doing it 30 or 40 years. So it is just kind of a.
So would the skeptical guy say, hey, well, what about, is bingo going to go digital?
Right.
Is that the kind of?
It turns out they already do have digital bingo cards and displays and things like that. So it turns out the biggest risk would be, and they already have a lottery in Texas, right? The biggest risk would be if Texas would ever approve iGaming and not sports betting, but iGaming, like online slots or whatever.
Right.
Some of those people that can only get their fix playing the lottery and playing bingo may go that way.
Right.
Since most of their business is this kind of stable charity, it's kind of a recurring stable base. It is churches, but it is, like a high school band that wants a trip will hold a bingo deal to try and raise $20,000 or something like. So there's a lot more to this business than you would ever think looking on the outside. But again,
now, is there regulation at the county level too, or does the state have it dictate the regulation for?
The state dictates regulation. The state dictates the payout. The good news is they have to get paid. They get paid every 30 days. Like if you are a charity, you have to pay them within 30 days. So and every month, kind of like the gaming companies, they have to file with the state, so you can go and actually see on a month lag what their business. I mean, it's like the most transparent, hard, not much of business you can find. I mean, it's
right.
But again, the website at the Texas, Gaming Commission, because it's under the gaming side, it's clunky and it makes Cedar look like a modern website. Then how horrible Cedar is.
Right. So let's get into your process a little bit. There's a lot to discuss here. It can go. We got fundamentals, technicals. How do you find your ideas? How do you gain conviction? What are some of your sell kind of disciplines? So let's kind of dig into that a little bit here and see.
My sell discipline is I hope that I get bought out. I think I told you before. I said I think I'm a pretty good analyst. I'm a horrible portfolio manager.
Right.
Those totally different skill sets. And I think people underestimate how hard it is to be a portfolio manager. And my whole career has been as an analyst. So if I was much better at position sizing and doing that, I'd probably be a lot better. But and I hear my dog huff puffing outside. He's 140-pound Great Pyrenees. So
Probably agreeing with you, right? Put me in, coach.
Oh my goodness, he's a show pony. Since I've been around a long time, I probably the things I use most. I actually did my list here. So one place for ideas is there's always a thread on Reddit, right? That do the quarterly newsletters for hedge funds and mutual funds. I love that. Because they're usually trying to pitch something in there, right? They're trying to show people how smart they are.
Right.
I mentioned mutual fund letters. If they're of similar style, GeoInvesting, Microcap Club, Value Line. I just know industries, so I just I know every restaurant, so I can kind of on a relative basis do that. Some days I just sit down and pick as Buffett said, start with the A's, and I'll just pick industry. I did that earlier this year. I did all the utilities. What a boring.
Right.
Because what was fascinating, what intrigued me about the utilities was every one of them would come out and they'd say, they always issue guidance in January, and they also, we're going to grow our earnings 6 to 8% a year. I mean, almost every one of them.
Right.
And I was like, well, that's weird, because some of them have different regulatory regimes, and some have a bunch of coal, or some are all nuclear, or, it's like they're in different states. Some of them have a lot of residential, some of them are, like, it's fascinating to me that this industry that's got 10 different variables that everybody thinks are really important somehow boils down to every one of them growing at the same rate.
Right.
And is that really true? So, sometimes it's just that you're like, wow, so I learned everything I needed to know about every, and I bought a couple after that, but so sometimes it's just natural curiosity of where to go. I do like going to conferences, LD Micro. There's one here in Dallas called Ideas Conference. That used to be a lot of really small microcap companies, and they've kind of moved up the chain a little bit. But again, Parrott's there, Gabelli sponsors it, things like that.
Okay.
And then, once I find something that's kind of interesting, and I'm like you, it's like there's always a kernel of, oh, that's the interesting thing. Right? Like it's a bigger cap company, but like, for example, I know a director on Green Brick Partners, the home builder. And I wrote up all the home builders in the mid 2000s for Tice. So I don't really follow them, but I kind of understand the business. And when I heard that guy talk, and how they did their business, about trying to get ahead of growth by buying a bunch of raw land and then developing all this stuff. And it was kind of different the way Darden or D.R. Horton and these guys do it. That was like, well, that's different. I want to take because when I usually talking to management is a double-edged sword, as you know, right?
Exactly. Yeah, for sure.
You don't want to get too comfortable with these people. And a lot of the losses I've had where I kind of overestimated I got too close to the management or whatever. Same time, one of the things I love to do when I meet the management, like when I go to LD Micro, I probably take 30 meetings. I only do one-on-ones.
Right.
I don't sit in on so literally from 8 a.m. till 6 o'clock at night, I'm doing a one-on-one with somebody. And the reason that I do that is I like to ask the why and the what. What problem are you trying to solve? And why did you choose this way to do it?
Okay.
And so it gets them out of their pre-planned pitch. You say, and then the other question I ask them is, take me on a sales call. Like, if it's a company that I don't 100% understand,
right?
I'll tell them, take me on a sales call. Who does your guys call? Do you use a direct sales force or whatever? And the more you can get guys to talk about that, the better it helps me with, everybody can run a model and do the numbers. So I like to get guys to talk about the why and the what.
That's such an important question. I mean, I always ask, just tell me how does the whole engagement process work? How do you find the customer? How do you talk to the customer? And how do you sell the customer? And how do you support the customer?
Yep.
know, and you want to, in that way, helps you understand, because a lot of these will have more than one product line too.
Yep.
So you want to understand that for each, I think, business segment also.
Yeah, because one of the things that I learned that is like when you have a guy, when a new management comes in and they're going to change this, like there's been a problem with sales, right? So they're going to change this, they're going to go to a direct sales force versus a distributorship, or maybe the other way or whatever. You know, one of the things I like to ask guys was the guy that's, because I had a job at Zacks Investments as a registered investment advisor for the end of my career. And they tried a new business model where they were trying to reach a different client base. And I was part of the group that was hired to reach the new client base. They called them hunters. You know, they were hunters and gatherers, which is a common term that they use in sales, right?
Mm-hmm.
But the sales manager, his whole life and his whole background was in the gatherer management style. So he wasn't really good at helping the hunters achieve what they needed to be successful, right? So that's what, going back to the sales question is, you know, oh, we're gonna do this in sales. This is how we're gonna, like you hear this all the time. This is how we're gonna jumpstart our sales, or this is why our sales are accelerating. But if you don't change your sales force, you keep the same dude in there that wasn't doing that well. Why do you think, you know, why is this the guy to do it?
Right.
You know, that company Transact Technologies, which people known forever, right? The woulda, shoulda, coulda with their BOHA,
Yeah.
their deal, the ticket in, ticket out guys. Guy on the board is now the new CEO there, and he used to be the CEO or the CFO at Salesforce, so he knows how to use Salesforce and the whole deal. And he was like a top employee at Oracle back in the day.
Mm-hmm.
And you know, he's like 75 years old, and they fire the old guy and they bring him in, and I'm like, why would you even want to do this? Because he was on the board for like 12 years.
This is TACT, right? Symbol. Yep.
Yeah, it kind of ran up as soon as they announced that he was taking over, and I think it's come down a little bit. But you know, our whole 20-minute one-on-one was him getting so excited about how poor the sales force was. You know, he's like, we would go to 40 trade shows a year and basically collect business cards and then not follow up on it and call that a success.
Right.
And so he's just so energized. But all right, I'm like, okay, so he's going to change the way the sales force works that hasn't worked for the last 4 or 5 years. But then I've had other guys that say, no, we're just going to go with what we got, and you can't do it. So I guess I got a little bit off on my process, but once
I know, Tim, that one of the areas where a lot of companies have, fail is a sales process, a marketing process. And because you can have a great product, great service, you don't market it doesn't matter.
Yep.
And,
yep.
I like talking to, and I like those are, you'll come across CEOs or something humble. Yeah, we made a mistake here, but now we fixed it. That they've gone through it. I like it. I like when you find that too, that they've already gone through a problem and then they've solved it.
Yep.
They won't do it again. So they've done it, or they've already been through it.
Yep. That's another question that I like to ask these guys is I say, pretend that I'm a new board member. I'm a new independent board member. And so you're going to onboard me with kind of how your company works, right? So that kind of gets back into the why. And they give you the spiel. And then I said, well, look, I'm sure that when you did present to your board, you had long-term goals, right? You have sales growth, margins, whatever it is, right? So let's pretend we're having the same conversation in 3 or 4 years. And the enterprise value of your company is where it is today. At Tice, we called it a pre-mortem, right? So what were the 2 or 3 most likely things that did or didn't happen outside of macro, because everybody has to deal with macro, that would have caused us to have no, it doesn't have to be a failure, but your valuation hasn't changed. So clearly something didn't work out the way you thought.
Right.
And that goes back to your point, because sometimes guys will say, well, I probably overestimated the size of the market, or we had difficulty finding talent, right? Those are good answers, right? Because they're thinking about it. I've had guys say, I really can't think of anything. And that is the wrong answer.
Yeah. Look against space. I mean, it's coming.
Yeah. But to your point about, well, in the past, here's how we fixed it in the past is a great answer.
Right.
Because a lot of times the guy that you're bringing in is being brought in because there's a problem. I mean, they just don't, oh, this company's hitting on all cylinders, let's bring in a new CEO. That's not how that happens, right? There is a problem. And if they can demonstrate that they've done it in the past and it wasn't kind of a lucky thing, they get a couple bonus points for that.
Right.
But if they say, I've made a few mistakes and here's what I learned, that also gets you a few bonus points.
Right. For sure. For sure.
If you're a CEO, you're flamboyant and intelligent and aggressive. I mean, that's how you get to be a CEO.
Right.
I also like talking to the CFO, especially the one where they'll go kind of look at you like, whatever he just said, multiply by 0.8, and I feel more comfortable about I love talking to CFOs more than CEOs.
It's good to get both. It's good to get both. It's amazing though. A lot of these CFOs know just as much as the CEO about the company, and they had a different perspective. It's good to, and there's a little more rational kind of thought there too sometimes with a CFO, right? Because the CEO is the idea man a lot of times, or idea woman, and has and you hear the passion, but sometimes you get the CFO who puts it all in focus for you.
Yeah, because he has to pay for it. It kind of, right?
Yeah. Yeah.
And that reminds me of another thing I look at when I'm looking at, so like going back to modeling and things like that. So once, this is kind of interesting company. And then we do the 10Ks and the annuals and the proxy. The proxies are great because you get to see who's on the board and, compensation and ownership, all that stuff. Then when I start, like, I like to build models, not to say, oh, they're going to earn 27 cents this year or $4, or I build it so then I can now tinker with all the different line items. Like, okay, what if they grew sales at 5% and they grew whatever, right? You can just, it's a tool to just play to kind of test the sensitivities of how the companies could work and see if how they, because at Tice, one of the things that we would do, we were the first guys to look at like cash flow as it relates to growth in sales and earnings. And as we say, earnings are an opinion, cash is a fact.
Right.
So I always start with the cash flow. I work from the cash flow statement backwards.
Okay.
I always start with the cash flow statement. And the other thing you got to pay attention to is changes in working capital can go all over the place to kind of, kind of screw up the cash from operations line, right? Because of swings. So I kind of like to look at cash from operations before all working capital changes, and then after to see if it matters, or if it's cyclical or whatever.
Right.
But then when I kind of get back to the income statement, I'm more interested in it, and it's kind of a way that a lot of people don't look at it. I don't care about, and I know that you do, and this is why I like working with you and your deal is you are a big sales growth guy. And I've read Phil Fisher's book, Super Stocks, another great book, because that talks about, kind of enterprise value to sales of technology companies that are growing.
Right.
But the thing that I learned, because I was the guy who had to write up Amazon back in the day for David Tice when it was negative cash flow business and it was going to zero.
Right.
I said, you guys are ridiculous. It's not going to zero, although I didn't buy a share. So who cares? But I had lots of arguments with short sellers saying you guys are wrong. So yay for that. But the thing that people missed, and the thing that I took from that, and I say this when I'm in these meetings with the CEOs and CFOs, I'm like, look, you can't spend gross margin. You can't spend revenue growth. You can only spend gross profit dollars.
Okay.
So, because if you think about how an income statement works, sales, cost of goods sold, gross profit dollars, and then everything else, SG&A and all that crap, right?
Right.
So unless you have 100% margin sales, COGS is going to take away whatever is up there.
Right.
So you have to understand if the business, and the thing I'm bringing up, Amazon was great. They were sacrificing their margin. Their gross margin was going down, which is what people, look, their gross margin is collapsing. It's eventually going to go to nothing.
Right.
But that was helping them grow their business. Their gross profit dollars, in spite of that, were growing faster than their SG&A and all their other expenses.
Okay.
So if you can grow your gross profit dollars faster than your SG&A and everything else, you're also going to get leverage at the business model. Now, are rising sales and rising margins better? Yes. But I think people get too tied up in the direction of the margins and not what's the net result of that.
Right.
I can only spend, as a CFO, I can only spend gross profit dollars. I can't spend revenue number, and I can't spend changes in margins.
Now with those, I don't know much about the Amazon, story and like you do in terms from that, because that was never on my radar. But so is it fair to say that maybe you sacrifice gross margins to bring in gross margin dollars sometimes to compete? Is that kind of what you're implying here a little?
Yeah, he famously said, "Your gross margin is my opportunity." That was one of his sayings. Okay. Now, what helped him out was he still while until he got to the point where he was cash flow positive, he was still burning through. He was still losing money, but at a slower rate over time, and then eventually it inflects, right? And he had the benefit of being able to sell stock in the secondary market to fund deficits. So that's, that has to be part of the component too, is I can only sacrifice margin so much before, I'm now in a death spiral myself. So
sure. But you need a good jockey. I mean, he's a great jockey. Elon Musk is getting, he can raise capital all day long, right?
Yep.
And that's important too, I think.
That is big time important, because generally speaking, I only want companies. That's why I have a hard time with growth companies, because a lot of times they're free cash flow negative, which isn't in and of itself bad, because obviously you're carrying inventory to grow your sales or whatever. But probably 75% of the names I look at, I would prefer them to be cash flow positive, because then that takes away that whole question of how are you going to get financed in times like today or whatever, right?
Right. So, today more than ever, cash flow is important, man. I mean, it's the capital isn't free anymore. So.
Oh, and if your business model, that's why, I don't mind investing in larger cap companies from the standpoint that that risk is not there. I mean, in the companies that I invested, that risk is not there. And that goes to the point we're talking about with the macro, right? So if I own a company that is economically, like Marriott, Marriott Corporation or whatever the hell they call it these days. If business slows down and there's a recession, will their cash flow go down? Yeah. Will the valuation of the stock go down? Yeah, it'll go down. But I'm not sitting there going, oh my goodness, they got a bond coming due, and if they don't get a coupon under 7, the business model changes.
Right.
So that's the thing at the microcap world. The other thing that you really have to look at is the capital structure. I see it all the time. Decent business model, horrible capital structure.
Yeah, good company, bad stock, right? That's just the syndrome and nano capital all day long.
Yep.
And I think a lot of the problems you have there is a lot of these CEOs don't understand that.
No,
they don't understand how important capital structure is to the stock, and that's why it's important, I think, to have to own companies where the CEO has a big position in the company.
Yes,
but it amazes me how kind of unaware they are how important that is.
Yeah, because again, they're the visionary guy, and they're worried about strategy and competition and things like that. And I mean, they're aware of their expenses, but yeah, they're not the CFO who every day is sitting there going, okay, we've got 9 months of money in the bank or whatever. And the other thing about the macro and companies is you see all the time now headlines, oh, interest rates are rising, and commercial real estate's going to zero and all this stuff. And then like everything in the same group. That's the other thing that happens now, is like every stock in an industry is like 100% correlated these days, right? They don't even differentiate capital structure or management quality or anything. It's just, oh hell, every bank is a zero because 20 of them have stupid long dated bonds, right?
Right.
So the more, if you forget the story and you just play around with the company's balance, if you understand that, I mean, there are times where you're like, oh yeah, you're right, this is a problem. But then there are other times you're like, well, that's not one of my 3 biggest risks, right? It may be 20, but it's not one of my 3 biggest ones.
Right.
And I see this now all the time with, rising interest rates are raising. I'm on Twitter every now and then, and I'm kind of snarky where they're like, wow, the interest expense doubled at like Apple, right?
Right.
And then I'm like, yeah, but their interest income from the $200 billion they haven't doubled too. So, it's like, because that was one thing about being at Tice, is we weren't a short seller. His fund was a short selling fund, but our research product was more of an earnings quality. Like we were the first earnings quality guys, right? but people took that as, oh, you're short sellers because you're pointing out bad things with good companies or bad things with bad companies, Enron included and things like that. But that's not really what it was. It was just, how do you look at companies? And I would get in these arguments all the time because I don't like to use adjectives. Like if you see the stuff that I write, I don't use a lot of adjectives like collapsing or it's up, it's down, or it is what it is, right? The numbers are the numbers. And I would get arguments all the time with these short sellers about, wow, you're way too just ambivalent or too neutral, or you're not drawing the conclusion that it's just terrible. And I've kind of prided myself, even when I write now for Seeking Alpha or Substack, I'm on those under Investing 501. That's our name. And I use that with another guy that I knew at Tice, because when we started this, like 2013 at Seeking Alpha, we were going to be educating people by our analysis. So Investing 501 was like the 500 level investment class.
Okay.
Not that it really is. Actually, the guy that I work with, Greg Yonke, he was one of the original CFA graders. So
oh, wow.
He has a really strong academic background, and he ran a value fund for a while. So we just thought, but when we would write up something on there, we would never say, and we think the stock is worth $24 a share, 20 times. That's right. The valuation is the opinion of everybody else.
Right.
I mean, it's just, a valuation is just an opinion of what the multiple, it's like there's no inherent ironclad number, regardless of what people tell you in college. It's an opinion.
Right.
And so all I know is that if the company does well, it could earn between this and this. What people decide that's worth is up to them.
Right.
That's
and then the longer they can do for you, it's a lot of times someone will ask you, what do you think it's worth? Well, you know what? I think it's worth a lot more than it is today than 5 years from now.
Right.
That's more even like short-term targets. You can kind of put some PEs on them if it gets there, but long-term it's really tough because it's really hard to forecast that far out, right? And are you paying a reasonable price for something right now? That's a question I like to ask myself. And can it be a lot bigger 5 years from now or 3 years from now? Exactly. And that's how I kind of look at it.
Like Mama Mancini's, or I guess Mama Creations. At this price, it's kind of discounting a lot of what it should happen if they do it right.
Right.
Because they have to if they get to a 15% margin and they get to 120 million in revenue, blah, 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 and you put a 9 multiple on it or 12, pick a multiple, the valuation's somewhere between 340 and 380, but they're not quite there. They're not there yet.
Right. They're 320 right now today. 320 for you.
320 must be down big today.
So sorry to. That's all right. All my stuff's down today too, so don't worry about it. Today's a weird day in the market.
Like that's a really good example of what we look for. Because you were familiar with it. I'm sure a lot of the viewers are. Carl Wolf, the old CEO, affable guy, nice guy, would go to all these conferences. LD Micros, where I met him, tells a great story. Folks, he had some history that he was doing great back in the day and everything. Great salesman, right?
Right.
And then you're like, okay, well, let's look at the company. And they like tripled their revenue, but their gross profit dollars were like flat, right? For all that time. So their margin collapsed from whatever 35 to 12, and not in a Amazon good way, right?
Right.
So you're like, well, what's going on here? And then they bring in this new guy, Adam Michaels, who came from Mondelez, right? And you're like, why would a guy that was at Mondelez come to work for this little teeny tiny company? And he turns out he used to be an M&A, and he used to look at companies like this for Mondelez to buy, right? So you talk to him and you realize, man, this guy's a professional. This guy's been doing this 20 years. And you're like, okay. And he was talking about the right thing when we're talking about how to fix the company things that we talk about. He was talking about the right things. I was like, oh my God, they don't do this and they don't do that. And it's incredible. They don't have a system that tracks sales or what, all this stuff. And again, you instantly recognize, holy cow, this guy I now understand what's wrong with this company. Gross margins are declining. This guy understands how gross margins are declining, and he's got a plan. And within like 6 months, their margins went from, the stock trades down to $1 because Connor Haley at Altafox, a legendary microcap guy that got caught up in Hasbro and You other got out of his circle of competence. He was a big shareholder. He left the board and he just was selling to get out. He needed a tax loss and lost money.
Right.
So stocks were all the way down to $1. $1. Well, at $1, it was worth like I don't know, $40 million market cap. And you're like, well, shit, if they can do $15 million in EBITDA, it's probably going to be higher than $1, right?
Right.
And within 2 quarters, he went from 12% gross margins to like 28. And then he's like, well, we used to use 7 truckers and now we use 2. And, I mean, like the fixes that they used were like instantly recognizable to anybody that knows the business. Yeah, that makes sense.
That was always my issue with the company was the margins. I mean, they knew how to grow revenue, and they had, get market share, but it didn't sense they had a good idea on how to grow profitably.
Right. And that story changed with the new guy. And then he's brought in like 3 other guys that were from Nabisco and, it's like, and they didn't take stock, which is crazy. They didn't, take a bunch of options. They're just getting paid and they took like salary cuts to go there. So you're like,
right.
Holy cow, there's this A-grade management team that is working for this teeny tiny company that's a simple business. Like in the long run, are they going to, their goal is to be the deli, right? The supplier of all things to the deli, right?
Right.
And olives and salads.
And they're known for their meatballs, by the way. They have the big.
They're known for their meatballs on QVC, which I haven't tasted them because in Dallas there aren't.
I had some in Florida because they're in the Publix there. They're pretty good.
Okay. Yeah. And I also talk about stock symbols, clever stock symbols. When they were looking to change their name from Mama Mancini's to Mama Creations, I said you should use the symbol deli because it was actually available and it makes more sense than Mama.
Oh, right.
Deli. I mean, come on. I was like, that's worth $50 million in market cap all by itself. But are they going to be successful in the long run of being the go-to deli guy? It's never been done before. There's probably a reason why it's never been done before.
Right.
But at $1, it's worth it. At $2, it's worth him trying. Would I initiate a new position at $3.50? No, because the story's got to change. I'm not saying that I'm a big seller, but it's like, again, know what you own and know why you own it.
Right.
And don't just say, oh, it's doubled, it's tripled because they're going to be successful as rolling up the deli industry.
Right. Well, now they got to execute, to perfection to keep the price where it's at now.
Yep, exactly.
So in terms of stuff like diversification versus concentration, how do you stand on that? Are you how many stocks do you own at your max? I mean, Peter Lynch owned 1,000. Are you at 1,000 yet?
I make the Russell 2000, look like a concentrated portfolio. It's a collector. Let's just say I'm a collector.
Okay.
I mean, if you'd see my liquor collection, you'd see that is definitely a problem. I own too many stocks because then after a while they become so small you don't care. I would say if I was doing this on my own if I was just opening my shop, let's just start that way. If I sold all the stocks that I own and then started over, the first thing I would do is I'm a big fan of equal weighting. There are some guys are like, oh, put all your money in your best ideas, right? I'm not adverse to concentrated portfolios. Concentrated would be like 20 or 30 on the outside, but at the same time, I'm not adverse to a guy. Remember, Peter Lynch owned like 1,000 stocks and did 20% a year.
Right.
But we're not Peter Lynch. Another way to do it would be like if you own 50 stocks, make all of them 2%. Because I'm not smart enough to know, which of my 50, everybody's like, well, these are my strongest ideas. And I know you guys have your top 5. And again, this is just a style difference.
Right.
I'm not like, that's why I would like, if somebody put a gun in my head and said, you have to own ETFs, I would own the equal weight ones. Like I would own the spider. I would own the equal weighted S&P 500. Right.
Let me tell you this, Tim. So you make a great point. And I think this is even more a relevant discussion in nano-cap land because you never know when the stock's going to move sometimes. They're not correlated to the market as much. And so for the last 18 months, I've been back testing a portfolio now. And it's a Cliff Note portfolio, my Cliff Notes. and it's 70 stocks, all nano caps, and equally weighted, and it's up, in 18 months, 25% by doing nothing.
Wow.
And that's not like incredible return, but there's no act. It's just riding all the bad ones down, and it's not doing anything.
Yeah, not rebalancing or anything.
No, and it's pretty amazing, and it's proven the fact that, like, maybe in Microcap land, it's not you can make money in a diversified portfolio.
Yeah.
Because of time. I'm not saying I think an interesting kind of way of looking at it is you having this kind of really high quality companies doing really well, equally weighted, and maybe you have maybe 5-6 stocks of really maybe some concentrated bets and some really big stocks that you've done some crazy deep dive into that you think are going to be just so much different and are going to be multi-baggers. I think those two together with a little bit of trading around is a pretty good little portfolio.
Yeah, I've used I would call that the barbell strategy, right? And I've tried to do that too. Unfortunately, most of my home runs have either round tripped or weren't home runs. But I think
Right.
I think that if you say, okay, I'm going to commit 10 or 20, pick a number, 10, 20, 30% of my portfolio to these potential 10Xers.
Right.
It keeps your risk intact, and so if they all go to zero, you lose 10%.
Right.
Who cares? But you only need 1 or 2 or 3 of those to go up 10x, 100.
Right. It's all about sizing everything the right way. And like there was a time, I think it was like the last 15 years was before 22 came along, was hard to have a diversified Microcap value-based portfolio.
Yep.
It wasn't working. And right now, I think it's working. I mean, if you look under the hood, I mean, everyone complains about nano caps right now, right? And we complain about it. But when you look under the hood, these really, garpish microcaps are doing well, and that these 70 stocks are all in that kind of area.
Yep.
So if you won't find that in the Russell 2000 or any of the indexes out there, even the microcap indexes, you won't find it.
No.
So I'm pretty excited to kind of like keep going down that path, and I think that's back here, and it's back here for a long time. Higher rates mean you got to have higher quality, invest in higher quality companies, and that's gonna be in these some of these smaller companies in nano cap land.
Yeah, no, and that's why doing deep dive, not even deep, doing our 1 hour analysis, like reading the conference calls of them and their 4 competitors, right? Again, this kind of deals with the macro. Oh, by the way,
Right.
Sean McEwen just called
me. Okay. Tell us hi.
So I'll talk to him. Inside joke.
Tell him to turn a freaking profit.
Oh my goodness. Nice, classic, nice guy. Knows his business really well, but maybe not good as a public company operator, is what I'll say. I still have faith in the business. It's going to be impossible to screw it up, but there's just
right.
And I think both of us have tried to advise him. I know we're going off the rails here a little bit. I mean, I think he's taken our suggestions and opinions to heart, and that he really is a good guy that wants to do well. But
I think he like admits like he thinks that like the CEO might be Chuck one day, right? I mean, I think he realizes that he's a typical idea guy, understands, he's already sold 2 or 3 companies in the past. He understands the bigger picture. I think he's great at that.
Yep.
And he's great because he understands his role. I mean, he had to be, when he first started the company, Coetel, KTEL, which I own some stock, by the way. Telecom, some cloud telecom services, as well as subsidized phone services to the low-income households that the government subsidizes. He understands the big picture. And when he first started the company, he had to be CEO. He was the only guy, there, and he basically bought some of these assets and turned them around when they reverse merger stock. Now he's brought in a really interesting company from Lingo to be on the board. I'm sorry, to not be on the board, but help run the company. And I think he understands that those are the future of Coetel.
Yep.
And he's not one of these like, hey, I got to be the CEO.
Yep.
He understands that, hey, next in line, it'll be their turn to take over this company if they get things going. So I like that about him, actually.
Yeah, I do too.
He's not adverse to taking that direction.
No, if if I call him back, we might talk for an hour and a half because he's very open. He's very willing to be honest about anything. And he's really
Right.
good about explaining things. So
Cool.
we'll see what, I mean, I emailed him after his earnings and had some suggestions. So maybe he's going to do that.
Right.
Going to the point about your portfolio is you can probably tweak it over time too by doing the management quality. Again, I don't want to oversell it, but the management quality relative to their competitors can be
Sure.
weaker. I mean, like in the restaurant space, Chipotle is phenomenal, right? Chipotle doesn't care what where interest rates are going, or generally speaking, right? I mean, their margins have increased, and they know what they're doing. But like you put them in their own little group, but then you can lump together guys like, so you could take Brinker and BJ's and Blooming Brands. There's like 5 of those companies that are all in the casual dining space that have been around a while. Well, you can start to see by what happens with the margins when costs go up, or labor costs, or whatever, or where traffic is going. You can go, wow, I can now put these 5 guys on a spectrum. So on a relative basis,
Right.
I can decide, well, wow, the guys at Blooming Brands are handling all these terrible macro things better than the guys at Brinker.
Absolutely. I mean, one company's excuse, for why they're doing bad, might not even be anywhere near what another company is. Like right now, it's very convenient for management teams to blame the economy.
Yep.
For how bad might be doing. Yep. But you look at another company, like in our situation, we own an NGO. It's DCMDF. Is it Datacom or what is this symbol on that? The name I always forget the name. I only know symbols.
I'm a big fan of guys that end in F, by the way, because it's so hard to get financials.
Data communication management. So there's the marketing side that they do some help companies with their printing services, boring, and some marketing around that. Mm-hmm. But then you look at a company like HHS. I think that's a symbol.
Yeah, Hart Hanks.
And it had a horrible quarter because they're blaming the recession. Yeah. So they're in the same area, but one person just does it better. And what I realized over my career here is, like, there's usually just really 1 or 2 or maybe max 3. I mean, buying the copycat in the industry often doesn't work.
I agree.
There's a leader for a reason.
Yep.
And I also like asking these CEOs when I'm talking to them about how they feel, how do they view their competitors. And there was one stock I came across recently, and we were talking about a story where she's telling me that like her competitors tell their customers to go use their product. Yes, that was pretty cool.
Wow.
And so you're looking for those things too a little bit. And yeah, so I mean, like you said earlier, that one thing I wanted to talk about really quick was management. Sometimes there's a fine line between getting an advantage from talking to management and losing that advantage over time if you get too comfortable with it and you believe everything they say. So I like that. I believe our first couple interactions with a management team, when I'm not really close to them yet, is really when I get the most out of it. If you've had a big position in it, you're too close emotionally invested, you believe everything they say. They're always obviously optimistic about something. So that becomes, but I think it's what's really important is that first interview, drawing down, or the first 2, just understanding the business as much as possible. And I think as you get better at this over time, you start to understand when you're getting bullshitted and not bullshitted. Mm-hmm. And if you're a young investor out there, you start doing this early. You start building that journal of companies that you follow that have lied to you in the past, or have consistently been, truthful or delivered on what they've talked to you about. Because it's always going to be, I remember there were companies in the 90s, early 90s, are still around today. And yeah, we're going to solve our customer concentration issue. Well, it's still the freaking same today.
I mean, exactly. That's probably the most important. Wow. That's one of the most important things investors in this space need to realize. If they haven't done it in the past, always defer to, it ain't going to happen in the future, right? I mean, that's it. Because you're right. We've solved it again. That's why management changes are helpful. But it's got to be a cultural. The other thing I talk about with these companies when new management is how do how are you going to change the culture? Right? Because if they're not on board with you, if the middle level management guy isn't on board, I don't care how grand your plans are. Right.
Right.
And so culture is underrated. And if the guy comes in and has these great plans and we see all the problems, but they keep 95% of the management team, well,
Right.
it's not gonna work, right? And going back to Mama Mancini's or whatever the heck, Mama Creations, 4 of the top 5 guys are new,
Right.
and they're doing a specific job. One of the companies that we said maybe we talk about this is Noodles.
Let's talk about that. Yeah.
We do that real quick. So first of all, there's none in Texas, so I haven't been to one. And originally, I thought they were Asian, right? I mean,
and their symbol, Tim. Their symbol.
NDLS, Nancy,
Okay.
David, Larry, Sam, and I am long. I did just write it up on Seeking Alpha. I did just write it up on Substack. I wrote it up right before the earnings, which were horrible, by the way, like 2 days literally before they reported just terrible numbers.
Right.
One of the jokes at Tice was, for my research, was get it, put it in a drawer for 9 months, then go out and read it, because it's probably time when I write it. Because you're writing up companies that have problems, and your ability to pick the exact quarter when they fix them is very rare.
Right.
But one thing about Noodles that intrigued me, first of all, 2 people I respect in the industry kept hammering me to go look at it. Right, going back to idea generation, dude, you have to look at this company. Why? It's a company that blew up twice, right? And in the restaurant business, it's really hard to turn around companies. I mean, Ruby Tuesday, Bravo Brio, Ignite.
Right.
I've owned some stinkers in there as well somewhere. But going back to our whole, I mean, like, if somebody would read this, they would learn my whole process, because like things that jumped out at me is, so they were owned by a company called L. Catterton. L. Catterton is a private equity firm that has owned lots of restaurant companies. They brought it public. They were going to grow at 10 or 15% a year because it was a small company, which is a typical small cap restaurant. We're going to, like Cava and all these, we're just going to grow forever. Grew too fast, expanded too fast, blew up. Blew up so much that they needed Catterton and another company to come in and give them some preferred, and they did an highly dilutive equity deal, right? So they stopped growing, and we have this joke about the Heitmann no growth strategy is one of my favorite things, is to find companies that are profitable, that blow up, because then they generate lots of free cash flow when they're not growing, right? And eventually, if they turn it around, then you get both margin expansion and everything else. Well, what intrigued me about this is these guys say the food's okay. Well, so there's a 13% filer. That's why you should always read 13D. 13Ds are awesome, right? Proxies and 13Ds are awesome.
Right.
So the 13% shareholder used to be on the board. He got on the board when they needed it fixed. They fixed it. He hasn't sold a share. 2 months ago, he goes back on the board.
Okay.
There's another company called Hoke, which is actually based here in Dallas. They filed a 13D a couple months ago. They own like 3.8%. Hoke and this other company both own another company called Natural Gas Services. So they may know, so it's like their investing style is similar. That's interesting.
Okay.
They bring in a CEO, they bring in a new CFO. The new CFO is the old CFO at Ruth Chris's, because Ruth Chris got bought by Darden. Oh, that's a real company. That's a real guy. He left for a good reason. Now he wants to do it again. It's like, that's not some random dude is now the CFO, right?
Right.
The CEO used to be the CFO. So he's been there the whole time.
Okay.
And so when I wrote it up, I was like, this company, they had a terrible quarter, but they still wanted to grow 10% a year in units. But they're outspending their cash flow, which again, I don't like. But if you just stop growing the company, they would generate, 20 or 30 million in free cash flow. And the company's worth, I don't know, 170 million bucks. So that's pretty good, right?
Right.
Free cash flow yield. And the title of my article is it time to grow or time to sell? And my conclusion is it's time to sell. So what happens? 2 days after I write the report, they have even worse numbers than they had the previous quarter. Like their traffic is down 7 or 8%, which again, if you look at all 34 companies in the restaurant space, That's way on the left of that.
Okay.
I mean, the whole universe is down about 7, but most of the public companies were better than that, right? Okay. And then so the stock craters from 320 to like 278 and comes all the way back to $3. And I was like, well, that's interesting because you know what? I wouldn't be shocked if I see another 13D. I would love to see another 13D being followed, an amended one, right?
Right.
And today, of course, Hoke has doubled their position.
Oh, wow.
So that's all, that's all cool in and of itself, right?
Uh-huh.
But the other things that are interesting about this company, going back to the proxy, is if you look at the board, their board is like the superstar board of any public company. This is a $180 million company. It's like the former the former CFO of Vail Resorts, the former CEO at like Blooming Brands, it's like this all-star board that's been there since they blew up the first time. So you've got 6 guys that have Rolodexes that are unbelievable and have been successful at every level in the restaurant hospitality space, sitting there watching this company wither away. I think the stock was like $6 early this year. It's $3, right?
Okay.
You got a new CFO. Their margins are, going back to our margin story, their margins are 13%. Historically, they've been 20. All right, they have a plan, right? The company was being valued at 5 times EV to EBITDA, growing its unit base at 10%. Literally, no one believes that they're going to be successful.
Right.
The PE should, or the enterprise value should be double that, right? Or
Right.
if people believe it, right? So that tells you that no one is giving them credit for growing anyway. So why grow? So it just has kind of all these elements. What's the biggest risk? The biggest risk is they can't turn around. And they do have $50 million of debt, but you've got and management owns like 1%. Right?
Okay.
So you've got a high concentration of ownership with highly motivated activists, a board that is A+, margins that could go up 700 basis points if they got their act together.
Right.
And structurally, it still will generate free cash flow next year if they now they're going to grow at 5%. So magically now they're going to grow at 5.
Right.
Later. Plus you have El Catterton, who's been in there twice before. So it's just one of these things. Like there's like 4, there's multiple shots on goal, right?
Right.
But hey, if the economy sucks, you're probably going to be in trouble for a while. But the fact that the recent 13D guy doubled his position, the CFO is a legit CFO. So
right.
What next? The board and the activists say, dude, you've been here since the beginning. You've been around for 2 screw ups. Time for a new CEO.
Right.
I mean, that would shock me at all.
Right.
Okay, now you get
maybe what they need. So
exactly. So now you get, because again, this is like the only guy that's been there for the whole time. The only common denominator is the former CFO who's now the CEO, and the guy owns like 300,000 shares, or he's just been there cashing checks. I mean, I don't disparage him, but he's doesn't need any capital, and he's been there twice since. So it's just one of those where, and again, if you bought it the day I wrote it, you were instantly down like 15% for 5 hours. So
yeah. Well, we could put on Geo. We'll put on now, get a better price, right? So.
Yeah, it was up like 5% today because of the filing, but
yeah.
But this is one you talk about valuation. Well, if they got their act together, and Ruth Chris just went out. There's been 2 or 3 acquisitions again in the space. Everybody loves buying restaurant stocks. Stop growing them, take the cash flow, and then flip it to go public again. You could make an argument that the stock could be taken out at some point at twice the price.
Okay.
Because I mean, just do some. A month ago they were guiding to 50 million in EBITDA, right? And now they're guiding to 35. Let's just say they eventually get it back to 50. It's a $180 million enterprise value company, and we're assuming that 50 doesn't generate any free cash flow, which clearly it would generate free cash flow because their capex isn't going to be $50 million.
Right.
And their interest expense is like 5. So you could make the case if they bring in a new CEO and they fix it, or they at least stop growing and generate some free cash flow and pay down some of the debt, you put a 6 multiple on, let's do 40 million in EBITDA.
Right.
6 times 40 is 240, and the stock's, the company's worth 180. It probably would trade for 7, so do 7 times 40, it's 280. I mean, the stock could be a double if they got that.
Right. Pretty easily. Yeah. I mean, I actually, this was funny because has been on my Cliff Note pipeline. I just haven't, but it keeps coming in and out of it. I haven't written up yet. So now this is interesting. This is going to help me a lot.
There's the 1 minute, there's my 3-minute pitch on it. Is a high quality board, clearly trouble. Plus the food's good. And like the other thing that's interesting about them is like 55% of their sales are digital, which is phenomenal in the restaurant space.
Absolutely.
And like 70% of their business is off premise. People come in the store, but they take it home because it's pasta. It's spaghetti and meatball or Asian noodles or whatever, right?
Right.
And they know what they are. You go to their website, they're in that space. I mean, I don't want to say they're the next Chipotle, but I mean, they know space is noodles. They know their space is takeout, carry out, convenience. Their average price is like $8 a meal, which is
okay.
competitive with McDonald's or Wendy's.
Well, it's perfect for this environment. Yeah.
40% of their customers make more than 100 grand a year. They're only in 31 states. They just signed a guy here in Dallas to build 10 new I mean, it's just screaming like, what in the world is wrong with this company? And the only thing I can come up with is the CEO is the only thing.
Well, that changes soon. Mike, we got to wrap this up, Tim. And this has been awesome, man. I mean, I wanted to do this for a long time, and maybe we'll have a follow up and do more in this. I could talk to you for 2 more hours.
Take it over, then we'll have another idea that we'll have to present.
For sure. Thanks, Tim. That's awesome, man. Awesome.